If you woke up today holding cash, you're already losing because silver just hit $95 and gold crossed $4,700. And what's happening right now could rewrite the entire financial system. In just days, two things moved at once. Metals exploded to record highs, and traditional markets hesitated. That is not coincidence. It is capital changing lanes. Gold above $4,700 signals institutional fear, not retail hype. Central banks are buying aggressively, governments are de-dollarizing quietly, and large funds are hedging against systemic risk. Silver at $95 is even more telling. Unlike gold, silver is industrial, used in solar, chips, and electric vehicles. When silver spikes this fast, it means real-world demand is outrunning supply. This isn't about short-term trading. It's about a structural shift, money moving from paper promises to physical assets, and most people still haven't noticed. Here's what most analysts are missing. Gold is being treated like insurance against political chaos. Tariffs, wars, sanctions, and rising debt. When governments weaponize money, investors run to metals. Silver is different. It's being squeezed from two sides. Investors hoarding it and industries desperately needing it for energy and tech. That's why the move looks violent. Supply is tight and demand is only accelerating. Meanwhile, the US dollar is losing psychological dominance. Countries are settling more trade outside the dollar, and that weakens the system that has backed paper assets for decades. Put together, record metals, stretched markets, rise in geopolitics, and a weakening dollar. That combination rarely ends quietly. It ends in a reset. Right now, three forces are colliding in plain sight. First, governments are printing and borrowing at levels the world has never seen. More debt means more uncertainty about the value of money itself. Second, investors are slowly losing trust in that money. You don't see it in headlines yet, but you see it in behavior. Less faith in paper and more demand for physical assets. Third, real resources are getting harder to secure. Mines take years to build, supply chains are fragile, and geopolitical tensions are squeezing access to raw materials. That is why gold is acting less like a commodity and more like insurance. It is being treated as a safety anchor in a shaky system. And silver is not just rising, it is breaking free from years of control and suppression. The move is too fast, too synchronized, and too global to be random. Banks may still talk stability, but markets are pricing stress. Every new record in metals is effectively a vote of no confidence in the current financial order. If this trajectory continues, the winners won't be the loud traders chasing quick gains. They'll be the quiet holders who positioned early in real assets. Here's what actually matters going forward. Watch flow, not opinions. When big institutions move into gold, they don't flip in days. They stay positioned for months or years. That's why this rally feels different from normal trading spikes. On silver, pay attention to inventory levels. If physical stocks keep shrinking while demand rises from solar, EVs, and chips, price pressure will not ease. It will accelerate. Markets don't fight shortages, they price them higher. At the same time, keep an eye on the dollar index. If metals keep climbing while the dollar softens, that confirms a deeper global shift away from dollar dependence. In simple terms, metals are not just rising, they are reflecting a change in how the world thinks about money, risk, and power. Now zoom out and look at positioning across the entire market. Right now, most wealth is still parked in leveraged assets, tech stocks, credit markets, real estate debt, and speculative finance. All of those depend on cheap money, easy liquidity, and total confidence in the system. Metals sit on the opposite side of that bet. They perform best when liquidity tightens, trust weakens, and risk rises. That is why institutions are slowly shifting portfolios toward gold and silver, while retail investors are still chasing quick gains elsewhere. In the futures market, something subtle but important is happening. Open interest in silver keeps rising while visible inventories keep shrinking. That is the exact setup that has preceded major price moves in the past. It is not panic, it is preparation. What makes this moment different is timing. We are seeing supply pressure, geopolitical stress, central bank buying, and dollar uncertainty all arriving together. When multiple pressure points align like this, markets don't correct, they transition to a new reality. And that transition rarely happens smoothly. Meanwhile, a quiet currency war is already underway. Countries are not announcing it loudly, they are acting through policy. Tariffs, sanctions, reserve reshuffling, and bilateral trade deals are slowly chipping away at dollar dominance. Every time a nation settles trade outside the dollar, the system behind paper money weakens a little more. That shift flows directly into gold. When trust in currencies fractures, governments hold more metal. This is not speculation. It is strategic insurance at a national level. The key point most people miss: this process is slow, but its market impact is massive. By the time it becomes obvious, the repricing is already deep. Silver sits at the center of this shift in a very different way. It is not just a hedge. It is infrastructure for the modern world. Every expansion in solar energy, electric vehicles, and advanced chips structurally increases silver demand. That demand is not optional. Industries cannot simply replace it. At the same time, new silver mines take years to develop, permits are difficult, and supply is already tight. That creates a built-in imbalance. Rising demand meets limited supply. When that imbalance grows, prices don't drift higher, they jump. Historically, gold leads during fear and silver explodes during stress. What is unusual today is that both are moving together at record levels. That tells you this is not a normal cycle. It is a synchronized signal across markets. Investors are not reacting to one event, they are repositioning for broader transformation in global finance. That kind of movement usually appears calm on the surface, but reshapes portfolios underneath, so the world stands at a real crossroads. One path is temporary volatility. Metals cool off, confidence returns, and the current system continues as before. The other path is far more significant, a multi-year repricing of money, power, and assets, where physical resources matter more than paper promises. Which path we take depends on three things: central bank behavior, geopolitical tension, and industrial demand for silver. The next few weeks will give us our first clear answer. Let's look at what institutions are actually doing, because behavior reveals truth better than headlines. Over the last year, central banks have been the largest net buyers of gold in modern history. That is not portfolio trading, that is state-level strategy, when governments stack metal instead of dollars. They are preparing for a world where financial power is more fragmented. At the same time, large hedge funds and sovereign wealth funds are increasing their allocation to hard assets, while quietly trimming exposure to highly leveraged markets. They are not panicking, they are repositioning with patience and precision. Silver tells an even sharper story. Visible inventories in major exchanges are draining, while industrial consumption keeps climbing. That combination creates a slow squeeze that can turn violent when retail money finally arrives. What most people miss is timing. Metals don't spike at the start of a crisis, they rise before the crisis becomes obvious. Right now, prices are speaking before politicians and media do. Now step back and think about the system itself, because this is where the real story sits. For decades, the global financial order has rested on three pillars: trust in the US dollar, confidence in central banks, and the assumption that liquidity will always be available when markets need it. Right now, all three are being tested at the same time. Governments are running record deficits, central banks are trapped between inflation and recession, and global trade is becoming more fractured by politics in that environment. Investors don't search for returns first, they search for safety. That is exactly what gold and silver are reflecting. What makes this moment different is that the shift isn't coming from one crisis, it's coming from many small pressures stacked together: debt, geopolitics, sanctions, energy transition, and technological demand for critical metals. Together, they create a slow but powerful current moving capital toward tangible assets. Markets rarely change direction because of one dramatic event. They change because the foundation underneath them quietly weakens over time. Metals are not reacting to today, they are pricing tomorrow. And that is why these levels, $4,700 gold and $95 silver, matter far more than most people realize. Here's the uncomfortable truth most people avoid. Markets don't move this way for small reasons. They move this way when the rules of the game are changing. Right now, money is being pulled in two opposite directions. On one side, governments want more control, more spending, and more debt. On the other side, investors want more certainty, more protection, and more real assets. Gold and silver sit squarely on the investor side of that fight. What you are seeing in prices is not speculation. It is a quiet rebellion against a system that has stretched itself too far. Every new high in metals is a vote against endless printing, political instability, and financial risk. At the same time, technology is making silver more critical than ever. The world is electrifying, digitizing, and automating, all of which require silver. That means demand is not cyclical anymore. It is structural. Supply cannot catch up quickly, so price does the adjusting instead. Put simply, gold is telling you the system is fragile, and silver is telling you the future is metal hungry. When both messages align, markets don't just wobble. They prepare for a reset. And we are now at the point where preparation becomes action. This is where the picture gets serious. If metals were only rising because of fear, the move would already be fading. Instead, it keeps strengthening, which means something deeper is shifting in the plumbing of the financial system. Banks still speak in calm language, but their balance sheets tell a different story. Rising leverage, hidden risk, and growing dependence on central bank support. Markets can sense that fragility long before it becomes public. Gold and silver are essentially acting like a seismic sensor for the economy. Meanwhile, geopolitics is tightening like a coiled spring. Trade barriers are rising, alliances are fragmenting, and major powers are preparing for a world where economic weapons matter as much as military ones. In that world, physical resources, especially gold and silver, become strategic assets, not just investments. That's why this rally feels different. It is not speculative mania. It is slow, disciplined positioning by governments, institutions, and industries that expect turbulence ahead. And here's the critical point. Markets don't peak before crises. They often peak right as crises are about to begin, which raises the real question most people aren't ready to ask. So here is where everything comes together. If this were just another market cycle, metals would already be cooling, analysts would be calling a top, and liquidity would be flowing back into stocks. Instead, the opposite is happening. Money keeps rotating into gold and silver. That is not random behavior. It is anticipation. Institutions are not chasing headlines. They are positioning for outcomes that haven't fully unfolded yet. Central banks don't buy this much gold unless they expect instability. Industries don't scramble for silver unless they see real scarcity ahead. And markets don't break historic levels unless something bigger is approaching. Most people still think in days and weeks. The smartest players are thinking in years. They are quietly preparing for a world where trust in paper weakens, resources become strategic, and power shifts away from traditional financial centers. And that is why these numbers, $95 silver and $4,700 gold, matter far more than price. They are not just records. They are signals. The system is speaking before the crisis does. The only question left is this. In the end, this is not about predicting prices, it's about reading the system. Gold and silver didn't break records by accident. They move because trust in paper is fading, real resources are tightening, and power in the world is quietly shifting. Markets rarely screen before change. They rearrange themselves first. And that rearrangement is already visible in metals. If you only watch stocks, you'll see volatility. If you watch gold and silver, you'll see direction. And right now, the direction is unmistakable. The world is moving from promises to proof. In the end, this is not about guessing prices. It is about understanding how systems break and rebuild. Gold and silver did not reach historic highs by chance. They moved because confidence in paper money is thinning. Real resources are becoming strategically scarce, and global power is slowly shifting away from one country dominance. History shows a clear pattern. Before every major financial transition, hard assets rise first. In the 1970s, in 2008, and now again, metals lead, everything else follows. Gold is acting like a global insurance policy. Central banks are not buying it for fashion, they are buying it for survival in a more fragmented world. That is a structural signal, not a short-term trade. Silver is telling a different, equally important story. It is no longer just a precious metal, it is a backbone material for energy, technology, and the electric future. When demand is structural and supply is slow, price becomes the adjustment mechanism. Meanwhile, the dollar is losing psychological grip, debt keeps expanding, and geopolitical tension keeps rising. That combination almost always pushes capital toward tangible assets rather than digital promises. Most people watch markets, the best players watch power, trust, and resources. That's where the real game is being played. So if you only track stocks, you'll see noise. If you track gold and silver, you see the direction of the world. And right now, that direction is clear. The age of paper confidence is fading, and the age of real assets is returning.